I expected FY26 to do better, so I'm not surprised that I don't think the first half was as strong as what the data shows, but it is definitely better than what people were expecting. But what is very encouraging is that credit growth is now starting to revive finally. Underlying that, of course, there are many other changes.
It also seems to be like inflation seems to be lower than the US, which is kind of very difficult to wrap your head around, right?
And which I think for the economy is again fantastic.
So what's happened?
There are some concerns that as China's dumping in export markets intensifies, it is also displacing Indian exports. And therefore the forward-looking assumptions on India's current account balance are not that bad. So all of those things are further supportive of growth acceleration. So I do think that growth FY27 will feel much better than what we are feeling right now. It's reasonable to expect that steady state inflation remains below what our inflation target is, which is why I think overall economic momentum will do better.
Hi, and welcome to a very special episode of Open Dialogue. After a few quarters of slowing growth, India seems to have turned the corner. The GDP prints for the last 2 quarters have been positive, at least in real terms, and things seem to be doing much better, driven by a number of things that have happened. Will this continue? What does 2026 portend for the economy? This is the topic for discussion today. Joining me for this conversation is Neelkanth Mishra. Neelkanth, welcome to the show.
Thank you, Samir.
So Neelkanth, to start with, I think about 15-16 months back, I think it was August of last year, when we'd done this podcast where we kind of predicted that the economy could slow because of both slowing government spends and also the tight policy by the RBI. And after that actually did happen. Now, Neelkanth, you, I think, were the first economists to upgrade the, growth rate projections for India in 2026. So, first, let's just start with that, and what's caused this change in your expectations, and what can we see in 2026?
So, if you take a step backward and see what happened in FY25, we grew at about 6.5% despite 130 basis points, so 1.3% of GDP worth of fiscal consolidation. So the explicit consolidation was about 80 basis points. So 5.6% of GDP went to 4.8 for the central government. States were flattish. But on top of that, and this is something that we should have grasped, but we didn't. It was only when the GST cuts happened that we figured out that the government had been collecting compensation cess, but was not spending it, meaning they were retiring some off-balance sheet debt. So there was 130 basis points of consolidation. On top of that, because of some of the measures made by the RBI, some of the steps taken by the RBI, the credit growth in the economy slowed very sharply. So it could have been the loan deposit ratio letters sent to some of the largest private banks. It could be the involuntary tightening of liquidity in the October-December quarter of 24, when the RBI had to sell $60 billion and therefore had to buy 2% of the system deposits. So the system liquidity tightened and credit growth slowed even further. So the slowing down of credit growth was a 2% of GDP drag on growth. So as you know, in our framework, there is trend growth, and then you do fiscal and monetary overlays on that. So, so the fact that trend growth, in my view, is 7. If fiscal deficit is shrinking, growth will be slower. If credit growth is falling, growth will be slower. If fiscal deficit is not slowing as fast, then you are closer to trend growth. So that's the framework. Now, in this framework, and it's a very simple way to explain that, is that if a plane has on-the-ground speed of 700 kilometers an hour, but this is despite headwinds of 250 kilometers an hour. If the headwinds slow down to, say, 150 kilometers an hour, then the on-the-ground speed goes to 800 kilometers an hour. So that's the simple maths that I expected FY26 to do better. So I'm not surprised that I don't think the first half was as strong as what the data shows, but it is definitely better than what people were expecting. Now, as we enter FY27, which is effectively CY26, the pace of fiscal consolidation slows even further. So what was a 130 basis point headwind in FY25 became a 40 basis point headwind in FY26 and becomes, in our estimate, at 20 basis points. We don't know that. I mean, that's our guess that the government will target a 4.2% GDP fiscal deficit. So it was at 20 basis points of headwind in the next year. So which means that the economy can be closer to trend growth. But what is very encouraging is that credit growth is now starting to revive finally. So we may end up at a neutralish phase. So the March quarter or the March end credit growth may still be 12-13%, maybe slightly higher, which is where it was in March 25. But after that, we think that credit growth picks up, which is why I think overall economic momentum will do better. And underlying that, of course, there are many other changes. Several of the steps taken by the central and state governments are also expanding potential output. So for example, if just this year, 7 states, very large states, have allowed women to work the night shift. So, if you're, say, opening a modern trade store or a hair salon or a restaurant, you need workers to work till 10, 11 p.m. And if women are not allowed to work legally after 6 or 7 p.m., which is where the labor laws were in India, then you have a significant constraint on labor. So the fact that this has been allowed is an unlocking of potential growth. So all of those things are further supportive of growth acceleration. So I do think that growth FY27 will feel much better than what we are feeling right now.
Right. So Neelkanth, I think just to kind of taking a little step back, basically what you're saying is that there is a trend growth, and trend growth is what economists would call like potential growth, like, what an economy can grow at.
Yes.
And that's a function of fundamental factors like, demographics, the policy framework, etc., etc., etc. According to you, our trend growth is 7% real. Around the trend growth, you have ups and downs which are driven by quote unquote shorter term things, as an example, credit growth or fiscal consolidation. So if the government spends, it will up the trend growth. Obviously, when the government spends, then there is subsequently some other effects, and then maybe the spend has to come down. If the government consolidates, which means that it starts to spend less, then it has a negative impact on growth, because obviously, that spend is not there in the GDP. Similarly, if credit growth is high, it's a impetus to GDP growth, because, people borrow and then they will use it to buy something. And so, again, the kind of, GDP growth will go up the trend. If the credit growth is slower, it will kind of go in the opposite direction. In FY26, both of these came together. So if our trend growth was 7,
FY25, it was
FY25, end of FY25, early FY26, which is when we did the last, the August 24 podcast, I think, was around where liquidity had become quite tight. There was this CD ratio thing going on. Also, unsecured loans were looking, how should I say, they were looking too high, and then the RBI came and kind of cooled that market down. So all of that kind of contributed to the credit growth side. At the same time, the government, kind of shrank the fiscal deficit more than what was even obvious, because there was this, as you mentioned, there was this off balance sheet that they were paying off. So they shrunk their balance sheet. Also, that was the election year. So, the first 6 months anyway, there was very little spend, and all of that came together. And so if this was our trend growth, actually we did this. This year or the coming year, your expectation is that both of these things reverse. Fiscal consolidation, according to you, will be only 20 basis points, much lower than what it was earlier. Credit growth is looking as it seems to pick up already. And so both should add to the trend.
Correct.
On top of that, as you said, there are a few things which are actually maybe shifting the trend itself because of the some of the things that you mentioned.
Yes.
So hence, overall, your expectation is that the growth will look more positive than it has. So Neelkanth, first, are you already seeing some signs of this? What are high frequency indicators saying?
Yes. So we have seen car sales pick up quite substantially. We have seen credit growth at the margin starting to improve. We have seen cement and steel volumes hold up very nicely, and real estate volumes, which had also slowed down, because as you know, for most households, the purchase of a house is the biggest purchase they make in the life of a family, and that purchase, the trigger point, is influenced heavily by where we are in the economic cycle. So if people perceive that things are weakening, their willingness to invest in their biggest purchase of their lifetime is much lower. So we did see real estate volumes also taper off a bit. And the reason I'm emphasizing real estate so much is that a large part of our investment cycle in the coming years is going to be driven by real estate. So that cycle, which had been starting to take off after 2022, so we had 2.5, 3 years, good years, and then we saw a tapering off because of a combination of these factors. We are now starting to see the sales volumes starting to pick up. Launches, because of course the real estate developers were still worried whether things are slowing down too much. So hopefully launches also pick up, construction activity picks up. So those are signs that suggest, or even if you look at the imports data, the imports X of gold and oil are actually looking quite robust. So there's clearly activity happening on the ground. There are some indicators which are not that robust. So like power demand is still weak. The retail sales for FMCG, fast moving consumer goods, which is staples, soaps and shampoos, for the branded folks, it's not looking that good. Air conditioners and some types of consumer durables are not doing well. So these are segments which are not doing as well as you would expect them to. But I think there are idiosyncratic factors which explain the weak power demand, the weak FMCG sales. And we can discuss that as we go forward in the discussion. But by and large, it does seem like the economy is on the mend.
So Neelkanth, one of the things that has happened, which is actually a little surprising, is what's happened to inflation. Because, I mean, if you look at it over the last many years, growth and inflation have almost always been positively correlated. I think after, maybe at least in my memory, is the first time perhaps where growth has picked up, inflation continues to be, or at least the deflator continues to be very thin. And it also seems to be like inflation seems to be lower than the US, which is kind of, very difficult to wrap your head around, right?
Yeah.
So what's happened? What's happened to...
That's actually a brilliant question. In fact, I must say that it is one of the most important questions in the Indian economy right now. There's this concept of economic slack or output gap, that suppose the total output that the economy can generate is 100 and it's growing at 7% a year. And if you're currently at 90 and you're growing at 8%, so you will reach at 98, but the potential output is now reached 107. So you still have a gap. And because you're starting with a 10% gap, you may have to run at 1% higher than trend for 10 years. I mean, of course, arithmetically it may be slightly smaller than that, but for you to be able to close that gap. It is only then that inflationary pressures become very serious and require policy action. So India is among the major economies of the world the only economy where the labor force is growing very rapidly. Now, most economists tend to think that the output gap or the measurement of utilization in an economy is only about that RBI Obicus survey, which is consolidated industry utilization number, or power sector utilization, or steel sector utilization. Actually, the most important driver of inflation is labor utilization, which is why you'll see that the Federal Reserve, which has a dual mandate, RBI only has MPC only has a inflation mandate, but they have a dual mandate where they have to manage unemployment and they have to manage inflation. So, so from that perspective, the fact that we are, based on whatever assumptions you make, between 7 to 11% below our pre-pandemic path means that we have at least 1, if not 1.5 years of excess labor in the economy. And therefore, labor does not have pricing power, which is why real wage growth is so weak. And this is why overall inflation is looking so weak. And so because in the last 1.5 years, we have seen first the political change, at least the elections and all the noise around it. And following that, Trump's election and the anticipation of the Trump tariffs, and then the Trump tariffs and the chaos that followed after that. We somehow lost track of the fact that the economy is still well below its pre-pandemic path. Now, using the framework we discussed earlier, if you have to fill this up, you have to use cyclical tools. So you either run the economy hot or hotter than normal by doing more fiscal spending, or you allow monetary policy to be more relaxed and much easier than you would in a normal state of the economy. And I think that there is so much slack in the economy that we can run at 7.5 to 8% for several years before sticky inflationary pressures start to come in. And this is particularly so given all the reform things that we discussed, that the new labor codes have been notified, the governments, state governments and central governments are reducing compliance requirements. So if you want to start a new business, if it used to take you 6 months earlier, maybe it takes a few months less now. And so the pace at which things happen is improving. What is also happening, and this is very important for financial services firms, is that there is significant capacity expansion in the financial services sector. So the cost of intermediation for the economy is starting to fall. So when what banks or NBFCs do is take capital from savers and then deploy it to the borrowers. Now, there is a certain cost, which is effectively the return on equity or the margins of the intermediaries. Given there is so much of capital that is being injected by strategic buyers or private equity, and of course retained earnings of all the large financial institutions, that the ROEs of these intermediaries are starting to compress, and which I think for the economy is again fantastic. So given all this, it is reasonable to expect that steady state inflation remains below what our inflation target is. The only problem here is food inflation, which is almost completely unrelated to these kind of pressures. It's nothing. There are some links to the labor market, but by and large, it is about weather. It is about complex cycles of, like potatoes. Once you have 2 bad years, suddenly the seeds are not enough. First year you prepare the seeds, the next year. So so there's a lot of complexity. The sugar market works in like multi-stage cycles. So food can, and it's very likely to rise from here. So the headline inflation, in our view, will remain close to 4% over the next 12 months or over through FY27. But that should not necessitate any further increases. Core inflation, or actually our measure of underlying inflation, is a best measure in our view is median inflation. What I mean by that, and let me maybe spend a couple of minutes explaining why it's important. See, when people look at inflation indicators and there are 1 or 2 items that are distorting it, suppose onion prices go up a lot. So on average, in the whole consumption basket, which is still continuing, the weight of onions is 0.6%. So if a household spends 100 rupees, it spends 60 paisa on onions. Now, assume that, or suppose that onion prices go up from 30 rupees a kilo to 75 rupees a kilo. So then 2.5 times increase, which means that 0.6 becomes 1.5. Now, two things can happen. One is that some people will reduce onion consumption. But the problem is in the CPI, that weight does not adjust dynamically. So they will keep assuming that the same amount of onion is being consumed, which is inappropriate. The second is, even if that doesn't happen, and suppose they're spending 1.5 rupees, so 90 paisa extra, it's not that their income is rising at the same pace. So basically, they will be cutting out something else. But that adjustment also, if you start doing X onions, inflation and all that is not very appropriate. So what academic research says is that the median inflation, so if you just list down all the items and see where inflation is from high to low, the midpoint is the most suitable because, it's not distorted by substitution effects or weights and all of that, is a reasonable approximation of where we are. So in that, we are, or the median inflation is been low for nearly 1.5-2 years. And so in our view, that suggests significant slack in the economy, and till it is filled up, sustained inflationary pressures may not be felt.
Understood. So basically, this is a situation where output in your mind is lower than potential. And again, kind of going back to this notion of potential is that there is, for every economy, there is a certain output at which demand equals supply. And hence, neither is there, when demand is more than supply, there is upward inflationary pressure. Correct. When supply is more than demand, there is deflationary, like prices will fall. And so the potential is basically at the level where the two are kind of balanced. In your mind, actually, we are operating below the potential. And hence, even if demand goes up, prices need not, rise at a median level. Obviously, that in these things, there are always the kind of the extremes. There are certain things which will continue to become expensive, certain things which will maybe reduce in prices. But on average, yes, prices should not go up significantly because we are behind our potential output. So great. So we spoke about growth, we spoke about inflation. I want to touch on one very topical thing and then get to some other stuff. The topical thing I want to pick up is what's happening to the rupee. Because just today, rupee crossed 91. And 90 was supposed to be this, big psychological barrier and so on and so forth. So Neelkanth, what's happening to the rupee and where do we go from here?
So the first thing is in exchange rates, we should not get too enamored of round figures. So 90, 95, 100, 80, 85. I remember writing a note in 2012, 2011. 50 is the new 40. And how does the economy shift and all of that. There are multiple layers to this assessment. The first is, do we have a fundamental balance of payments problem? So generally, when the rupee weakens substantially, and it has gone from an 88 handle to 91 handle in a very short 1 month period, it does. So that's the one reason why people are starting to talk about it a lot. So the first question to ask is there a fundamental balance of payments problem? Meaning that is there more demand for dollars than supply of dollars? On that, there is a current account and there is a capital account. So the current account is the trade balance in goods and services. The capital account is how much capital are we getting to pay for that deficit on the current account side. So the only big changes that have happened are that gold prices have gone up by more than 50%. And Indians in this cycle, so the last time the gold prices flared like this, India was a much poorer country. Today, we are still not a very rich country, but there are enough wealthy Indians who can speculate on gold. So generally, the household demand for gold is, inversely correlated to price. So people will say that, for that cousin's wedding, I will pay 25,000 rupees of jewelry. Now, whether you get 3 grams or 5 grams or 10 grams, it does not matter, 25,000 rupees. So if prices go up, volume goes down, the imports remain the same. The challenge with investor demand is that it's pro-cyclical. So prices go up for gold and silver, they keep buying more and more. Do you see that The AUMs of ETFs are spiraling up for gold and silver. People are selling structured products. So assume that gold volumes remain the same. So November, the 12-month rolling volumes had started to normalize. So October was very strong, but November gold imports had started to normalize, which means that there is about an $18-20 billion an additional impact on imports. So you have to now find those $18-20 billion. So all the people buying gold or silver are effectively shorting the rupee, meaning they're saying that the rupee has to fall. That's not what their intention is, but that's what they're effectively driving. But then on the other hand, you have oil imports, which where $1 per barrel, as we've discussed often, is $1.8 billion. So if given that oil prices are down $10 a barrel over the past 1 year, there is an $18 billion advantage that you have. In fact, in November also, we saw that net oil deficit fell by $2 billion. So in a month, if it falls by that, so 18, 20 billion, $24 billion is the range. So gold and oil kind of cancel each other out. If we go forward next year, especially if the Russia-Ukraine war ends, and now it does look like with all of the pressure, things are starting to come to an agreement. Then the Nord Stream 2 pipeline comes up, gas prices fall, oil prices fall. So there are lots of those things that can happen. And therefore, the forward-looking assumptions on India's current account balance are not that bad. In fact, there are some concerns that, and I think those are genuine concerns, I have those concerns as well, which is that as China's dumping in export markets intensifies, it is also displacing Indian exports. So it's not just about China dumping into India. If China dumps in, say, some other country where Indian exporters are getting displaced, that's also a problem for India. But our services exports are rising at 11 to 13% year on year. So that's an additional $30 billion that you get in a year. So current account, I don't think we have a problem. On the capital account side, the only big change has been over the last 3 years, a rise in FDI repatriation, which is that multinationals which are operating in India are realizing that they can sell their shares here and take the money back. It's very low cost of capital. And so they're selling that and taking the money out. Private equity, venture capital are getting exits. But you know what? This is of course, this what used to be a $20-25 billion level has now become a $45-50 billion level. So there's a $20-25 billion of extra outflows that are starting to happen, which has increased the dependency on portfolio investors. So foreign portfolio investors also have been net sellers over the last 12 months. Most of these are, in my view, temporary factors, because you see that the direct investors are now coming back. So we saw, Amazon promising $35 billion of investment, Microsoft promising, I think, 17.5, Google, $20 billion. So all of these investments, and also they come with a timeout. So they have $72 billion coming in 4 to 5 years, which is substantial. On top of that, you have many of these strategic investors in financial services, which are all, again, not fly-by-night operators. They're all, so as they're committed, I am sure it's a matter of time before the portfolio investors also turn back. So there is a challenge right now on the balance of payments, but that's not a very structural, fundamental challenge. So that's point one. The second fundamental view is that the real effective exchange rate. So in some of our earlier episodes, we have discussed that there is a bilateral exchange rate, which is USD INR. There is a trade-weighted exchange rate, which is that if you are trading 10% with Japan, 10% with Europe, 20% with China, 10% with Japan, with the US, you do the weighted exchange rate and you get something. You adjust it by inflation, you get the real effective exchange rate. The REER, REER, is the most appropriate measure of a currency's influence on your export competitiveness. So the REER is now down to 10-year lows. So even from a fundamental export competitiveness perspective, there's no argument to be made that the rupee needs to fall more. So fundamentally, there is no reason for us to worry about the rupee, especially given that the RBI does have $685 billion of reserves. Now we come to the more trading speculative perspective. The challenge with currencies is that there is no fair value. Because as we've discussed often, currency, that piece of paper, if you remember one of our first episodes, that what is the value of this piece of paper, right? So, so therefore, in the near term, there is no anchor. And that anchor, to some extent, is established by the Reserve Bank. That, look, this is enough. Now I'm coming and putting a stop to it. If you do it too often and at an inappropriate level, there is a problem. So when the RBI tried to peg it at 83 for too long, I think it was a mistake. When that peg broke, it did a lot of damage. Some of that damage is now showing up. So between August and October, of the $33 billion that the RBI had to sell, $24 billion was just the delivery of the forward shorts that they had made last year. So, for example, is to explain, when the RBI intervenes, it can intervene in the spot market, cash market. That is, they effectively buy or sell dollars. So they sold $60 billion to offset the fall. In addition, they also sold $90 billion of forwards. So they said that I'll come and sell in the forwards market. Now, for a while they rolled it, meaning that, there's a forwards matured, they put another forward on. But now they are starting to take delivery. So effectively, they are having to sell dollars. So there is still about, I think, $15-20 billion extra that they need to sell, which is a challenge. And again, there was an attempt to, I think, hold 88.5 as a level till a couple of weeks back. But now the RBI said, you know what, I'm not holding any level. I will manage volatility. Now the only point is, at what level does the RBI signal that I'm done with volatility also now? That in a 3-month period or a 1-month period, I will not allow more than this movement. So at some point the RBI steps in. Maybe we are now approaching that level. Maybe 91, 92 is that level where they come in. It is wrong to get anchored to, certain like round figure. It could be any number and it could be a percentage change. Personally, I think that we are now heading into a period of competitive currency debasement. We've discussed that in prior episodes as well. I think the challenges of the US dollar are intensifying on multiple fronts. So like today, I read that, it is cheaper to fly to Japan, to Disney World, stay there for a night and fly back than to just spend one night in the Disney World in Florida. The other day, someone tweeted that a Four Seasons in Shanghai costs $250. Most of Asia is actually in that range. Four Seasons in New York costs $1,120. So the dollar is clearly overvalued. And the second perspective is that the tariffs are clearly not working. So when they put 50% import duty on steel, guess who got hurt the most? The farmers. Because all the farm equipment manufacturers got more expensive steel, and what do? They will raise prices. So tariffs, he had been told that they won't work, and they're not working. So eventually, what does the US government do? They'll have to devalue the dollar. So this time, unlike in 71 and 85, to reiterate something we have discussed earlier, it's not that the Deutschmark equivalent or the euro, that is, and it's not to say that the other countries don't matter, but the parallel to Deutschmark is the euro today, and the JPY, the Japanese yen. They are not going to let their currencies appreciate till the Chinese are letting the currency appreciate. So we are going to get into this period of competitive devaluation. So frankly, in the run up to that, if the rupee is starting a bit weak, I don't really have a problem.
Understood. So quickly to summarize this, Neelkanth, firstly, historically, and India had many episodes actually of very sharp depreciation in the rupee. It has typically occurred along with some kind of a weakness in the balance of payments, right? Either the like in 2013, let's say, when inflation was it was running away, and government fiscal balances were not looking great, and so a lot of capital was rushing out because India's macro didn't look. We were then at the fragile five and so on and so forth. This time around, actually, the depreciation is happening in a context where actually our macros look quite decent. In fact, they look quite strong.
Yes.
Deficits are controlled. Inflation is, I don't know when we've seen inflation of this nature.
Exactly.
In the last, very many years, in our lifetimes perhaps. And growth is strong and so on and so forth. And it is happening, it seems to be a very technical reason, not linked to fundamentals. And the technical reason is that at the end of the day, the exchange rate is simply a function of how many dollars are available and how many rupees are available. And how many people, how many folks want to buy the dollar versus the rupee. And at this point in time, because of on the capital side, which is there are large multinationals who have realized that their Indian subsidiaries are more valuable than their own company, holding company, and so they've diluted, they've taken money out. A lot of private equity guys have taken advantage of the stock market buoyancy, exited their stocks and taken money out. A lot of people are actually, because Indian stock markets did so well in 24 and the global markets didn't, they saw perhaps some kind of valuation arbitrage. They sold here, they put money into other markets, and the markets have all done very well actually. So there is a outflow of capital from the country, which means people are selling the rupee, buying dollars, and that is what is resulting in this depreciation. And as we've discussed multiple times in the past, actually, neither depreciation nor appreciation is a problem. These are all self-correcting mechanisms. The problem is, these are maybe, these are symptoms of something which is, if the rupee is depreciating because deficits are very large or inflation very high, it is a problem.
Yes,
but not because the rupee is depreciating because the deficit is high or the inflation is high. And vice versa as well. So in this case, it's fine if the rupee depreciates, our exports become more competitive. It'll kind of benefit. It'll maybe do away some of the tariff impact and the like. So that's broadly on the rupee. So let's move on to the next one, which is interest rates. Again, interest rates are at extreme low levels, quite honestly. And so, kind of, what do you see happening here?
So, again, interest rates, there are multiple interest rates. So, you're right that at the short end, which is very short tenor loans, or what the RBI sets as a repo rate, which is the overnight rate or the 14-day repo, that rate is at very low levels. We've rarely seen rates as low in a normal time. During crisis times, of course, in COVID, they were much lower. But at the same time, the slightly longer tenure rates are still not low enough. So if you look at the gap between the 10-year government bond, which is the 10-year risk-free rate in India, and so that is at say 6.6, and the repo rate is 5.25. So 1.35% term premium, or at least a spread, is especially when you are coming to the end of the rate cut cycle, is an atrociously high level. So the question to ask is, why is that spread so high? And in bond market parlance, why is the yield curve so steep? That the way it is plotted is that on the x-axis you have various durations, and then you plot the interest rate. So it'll be like going up like this, which means that, oh my God, so it's such a steep yield curve. When the rate cuts at the short end are towards the end, it tends to flatten out, but that's not happened. Question is why. And so our forecast, and that's another thing we are stating in our outlook note, is that we expect the 10-year yields to fall. So a lot of the monetary easing that may happen may not be through a cut in the repo rate. It may actually happen through lower 10-year bond yields. So how will that be brought about, or why is it so steep? I think a very important consideration here is the issuance. So as the government issues debt every year, it can make a choice. So it can borrow the same amount, say say the net borrowing is at 12 lakh crores from the bond market. It can borrow the same amount, but it can borrow, say, 100% in T-bills, which would be very bad, but it's a theoretical possibility. Or it can borrow all the 12 lakh crores in a 30-year bond or a 50-year bond. So that choice is independent of where the fiscal deficit. I mean, the fiscal deficit can be the same, but you can do both. Now, what the government has done over the past couple of years is it has stopped issuing T-bills, and there is a good reason for that. I'll explain that. And the duration of issuance. So, in the last 2 years, the incremental issuance has been at a 20-year duration. So basically, the weighted average duration is 20 years. As a result, the duration of the stock of debt, so the total government debt, the duration is 13.2 years now. 10 years back, it was less than 10 years. The US, in comparison, of course, on fiscal issues, the US is no longer the best benchmark, but it's at 6 years. So, this is prudent, meaning that extending. So what happened in 2013 is that when the taper tantrum happened, the RBI and the government realized that increasing duration is important to reduce refinancing risk, meaning that if you have very short-term loans, you have to refinance it very often, and so if the rates go up, then your fiscal burden increases very rapidly. So to improve predictability, improve stability, it is important to increase durations, which is great. So when we wrote this note, we actually called it too much of a good thing. So if you start doing, say, suppose someone says eat or drink a lot of water, doesn't mean you eat 8 liters of water, your kidneys will fail, right? So it's not that bad, but it is in that direction now. So if you can't have 20-year average duration of issuance. And what has also happened, because on the T-bill side, that look, 2 years back, the government started this scheme where when the center transfers money to states, it said that earlier they would transfer whatever was due on a regular schedule, but then they said no. Now, if you spend the money we've given you and then the balance draws down, then we will replenish it. So just in time funds transfer. So earlier what used to happen was that the state governments would get all of that funds, the surplus, they would park in some bank account. So it remained in the banking system. But now all of that money is still accumulated at the center, and the center banks with RBI. So that money goes out of the banking system. And it was creating undue volatility in the overnight liquidity and those markets. So the government said, oh, you know what, we anyway have liquidity surplus right now, and therefore we will not issue T-bills. So, from Jan 24 to now, so almost 2 years, the outstanding T-bills have fallen by 2.5 lakh crores. So imagine if in FY27, the government builds around it and says that, I need to have more T-bills in the market. I mean, you look at, again, the US is at 22% of outstanding T-bills, which is, of course, very dangerous. India is at 8%, which is like the all-time low. So this is also very distortionary. So if you just switch 3 lakh crores or 2.5 lakh crores of borrowing from a 10-year to a T-bill, the demand supply for T-bills, the 10-year bond becomes much better. And I think the 10-year yields can actually fall by 25-30 basis points just on the basis of that. That level of decline in yields is my guess, but there will be a reduction. So this is one factor, that the duration and plus within bonds also, doing less of 20-year and 30-year, doing slightly more of 5-year and 7-year is actually important to sort of manage the demand supply at various levels of duration. The second aspect is that we are so anchored to high inflation. As you said, in the average inflation in the last 65 years has been 6.5%. So we've never seen sustained low inflation like this for a while. So everyone is anchored to, inflation will go up. So the assumption is that in the next 1.5-2 years, the RBI will be raising rates again, which could happen. But the likelihood of that happening, as we discussed earlier in terms of the slack in the economy and how long it will take to close that slack, even the COVID-related shock has not really be fully, covered yet. So there is a lot of slack in the economy. And what that requires is a sustained level of strong growth. But it is very unlikely, in my view, that the RBI will need to raise rates in the next 1.5 to 2 years. So, but that's what the markets are pricing in. So as both of these things happen, as the market discovers this, I mean, it's not about RBI signaling. I don't think they can give these kind of forward-looking numbers. But as they work towards this, I think that could be another 20-25 basis points drift down in yields. And lastly, there is a demand supply argument. So as the fiscal deficit shrinks further, the issuance will grow less than nominal GDP. The incremental demand from banks is likely to grow in line with deposit growth, which we think will be stronger, and therefore that should also be supportive of lower yield. So from the monetary policy perspective, if the RBI keeps liquidity in surplus, and they have said very explicitly that 1% of NDTL will be the overnight surplus, and so that remains in surplus, the issuance maturity, the visibility on how long rates will remain lower for longer, basically, will, I think, keep pushing the rates down. So the cost of borrowing can actually keep falling, even though the repo rate is not likely to fall much.
So Neelkanth, this time we've tried a new format. We've asked a few questions from the audience, and obviously we've got many. So let me put a few of those for your responses. The first question is for 2026. What are the big risks that could impact growth or incomes, etc.?
So as usual, all of our forecasts are fraught with uncertainty. So there are many assumptions we make which may not really fructify. So for example, as the global policeman pulls back, so what we are seeing is like the Thailand-Cambodia war, again, reigniting. There is stuff happening in Africa. There is stuff happening in Venezuela. And if any of these results in, say, energy prices going up, then a lot of the favorable balance of payment trends that low oil prices create goes away. Within the economy, you would have seen how disruptive the Indigo experience was, though it was only thankfully for a couple of days. But if we see another couple of these episodes where some of the large dominant firms in any particular sector, because of internal idiosyncratic reasons, and I personally think that Indigo problem was a classic efficiency versus resilience balance, and they became too efficient and therefore were not enough. They didn't have enough resilience. But if it results in another such big problem happening, then the opening up that we are seeing in the government then starts to backtrack. We can also see, as we were discussing earlier, significant currency market fluctuations because when all other tools have stopped working, or at least the available options are too hard, it's like the US, in order to solve its problems, can do the hard things, can build infrastructure, ease regulations, force people to consume less, but those things are too hard politically. So it's a much simpler solution to just kill the dollar. And as that competitive pressure builds, I think there are risks that will emerge. China by itself, I think, is a very significant risk to global manufacturing. A lot of the analysis on China seems to assume that their manufacturing dominance is in the rear view mirror. That, China is dumping so much. They're going to dump a lot more. So just to give you a sense of scale, China produced 3.5 million cars in November. If you annualize that, that's 42 million cars. The global car market is 84 million. So they're already producing 15% of the global cars. And it's not that they're slowing down. In sector after sector, I think they're going to do this. I was reading somewhere that the so-called increase in consumption is only for barbarians, basically the non-Chinese, that, the signaling that, oh, you know what, we are going to rebalance the economy. Whereas apparently when Xi Jinping went to Korea, he stayed in a 4-star hotel on a state visit. It was a signal to these Communist Party cadres that this is a time for belt tightening. So these are all risks that are still ahead of us. And as you're seeing now, Mexico has imposed 50% tariffs. The ASEAN countries don't really have an option because they are into RCEP, but at some point they could impose some of these tariffs, and then India may be forced to impose. So we are in for a period of significant geopolitical turbulence in the next 5 years, maybe 10 years, 15 years. And I think we should expect and anticipate a lot of internal shock or other intermittent shocks to the market and the economy. But at the same time, the drivers to growth remain internal. So if we manage our real estate cycle well, the supply on the real estate side is managed and handled reasonably well, and we don't commit monetary policy or fiscal mistakes, I think the risks to our growth are relatively manageable.
Great. Second question, Neelkanth, is given the rates where they are, is 2026 a good time to buy a home or a car?
I think so. So price to income ratios are low. So in real estate, I know for most of the people in this audience, mortgages are very important, but the percentage of Indian homes purchased or built with mortgages is still very low. So what matters for the real estate cycle, in my view, is just the price to income ratio and inventory levels. Both are still at manageable, in fact, I would say very low levels. So which means that the cycle is still in early stages. Some economists who visited India a month back or so said all of India looks like a construction site, which of course is terrible for air quality and people with young kids and elderly parents. But for an economist, that's wow, that's amazing, right? So growth will be strong. So I do think that this is for housing for sure, yes. Cars, I don't know if low interest rates are the only determinant. Will there be bigger model refreshes? Will electric vehicles become much cheaper? And will you get much better quality cars? Will the upgrade cycle accelerate? So those are bigger questions. Frankly, I'm not an expert on this.
Sure. There are many more questions, Neelkanth, but let me end with one, which is will tax cuts help the GDP growth in the coming year?
Not really. So the GST cuts perhaps, because the effective indirect tax rate, which when I was part of the advisory committee to the revenue neutral rate committee of Arvind Subramanian in 2015-16, we had estimated was 15%, 15.3%. Our estimate of current effective GST rate is 10.3%. So you've seen really a 5% point fall in the effective rate. GST collections as a percentage of GDP have actually flattened out, which means that there's been much better compliance, much better spread. The Laffer curve has shown up. So that's productive. That actually helps productivity, that helps formalization, reduces the unfair burden on some people and all that. But the income tax cuts, for example, that were announced in the budget this year are, of course, help a certain segment of the population, the people whose disclosed income is about 12 lakhs. But at a macro level, the government was still reducing its fiscal deficit. So the government was still a drag on aggregate demand. Even on a personal income tax basis, while they're missing that number by a mile, but the budgeted income tax collection growth was 14% year on year, which is higher than the nominal GDP growth that they're estimated. So if the government is shrinking aggregate demand, their investment to GDP ratio or capex to GDP ratio is flat, which means that whatever is not investment, which is consumption, is actually a drag. And even on income tax, they're expecting far higher collections despite the cut than nominal GDP, means that actually there's no boost to growth. Were the tax cuts necessary? Perhaps yes, because reducing the tax burden on some of your most loyal taxpayers actually is encouraging people to formalize, and it helps the overall sort of tax compliance. But by itself, I don't think it's a macroeconomic boost.
Great. Thanks a lot, Neelkanth. A very interesting conversation. Just to kind of summarize your view on the coming year. First, on growth, you're very positive. You believe that growth will be higher than potential, which is 7%. So it will be higher than 7% for multiple reasons. But primarily in the last, let's say, FY25 and some bit of FY26, we saw headwinds coming out of fiscal contraction and very sharp fiscal contraction. Also monetary tightening. So the government reduced its spending very significantly, and the central bank also had fairly tight monetary situations. Liquidity was tight. There was all this attempt to slow down credit, which resulted in headwinds to growth. But now those are reversing. So the fiscal contraction of the government is unlikely to be as sharp as it was in the past. And on the credit side, actually, credit growth is expected to come back. Already, we are seeing some early signs of that. So these two things will help growth. In addition to these two things, there are a few things which are helping the potential growth itself. Like you mentioned, some changes in labor laws and the like, which are helping growth anyway. So all of these coming together, you see growth come back. Inflation has been at a historical low. I don't think we've seen inflation at this level ever. And that is, in your mind, that is because of the slack in the economy, which is the economy actually is operating far below its potential. May not be far below, but definitely below its potential. And hence, in your mind, the economy can grow very fast without inflation coming back for a reasonable period of time.
Yes.
And so your expectation for inflation is that it will be moderate. It will be in the 4% range. Food inflation will come back because food inflation has got nothing to do with slack and so on and so forth. It is far more based on weather patterns and the like, supply and so on and so forth. So food inflation will come back, but overall inflation should be in the 4% kind of range. So we are looking at a period of low inflation, high growth, which is a very rare occurrence in most economies. So from that perspective, we are looking at a good FY27. On interest rates, your expectation is that interest rates will remain low, and actually at the longer end of the interest rate curve, which is the 10-year, etc., you expect it to actually fall further, primarily driven by supply of paper moving from longer duration to shorter duration. So your belief is that the reason why the 10-year is so much higher than the overnight rate is primarily because a lot of the government supply is at the higher end of the curve. They are issuing 30-year paper, 20-year paper, etc. And hope you see that the government will start coming in at the shorter tenor, do more T-bills, do more 5-year paper, 7-year paper, and hence the longer end should come down. And a lot of actually interest rates, like lending rates, are linked to, maybe some of them are definitely linked to the longer end of the rates. So that could come down. And last, we spoke about exchange rates. And so on exchange rates, as we discussed, there is no kind of number you can peg to. But the rupee seems lower than what it normally should be, because the current account and the balance of payments in general is not bad. It is a significant outflow of capital on the capital account, driven primarily by equity money moving out, either MNCs taking money out of India, or the private equities and the like selling, and obviously also FPIs selling and taking money out, is what has resulted in this kind of a situation. And as you said, the real effective exchange rate is at historical low, 10-year lows.
10-year lows, yeah.
And so there is not much space for the rupee to depreciate. It could still depreciate given technical flows, etc. But that should be temporary, and we should see that come back. In any situation, we are likely in a kind of a globally, this competitive devaluation of the currency type of an environment. So lower rupee is not that bad a thing. But in general, your expectation is that we are perhaps at a low point already.
Yes.
And so if I were to summarize all of this for FY26 for all of us, looks like a promising year, because we will likely see good growth at low inflation and at low interest rates. And exchange rate, obviously, it will be what it is. So it's a very interesting year that we can look forward to, because there are very few occasions when these kind of things come together. Typically, if the growth is high, you will also find that the interest rate is increasing, or inflation is rising and things are becoming more expensive. But we may actually be in a place where growth is good, which should then translate to incomes and income growth and so on and so forth for all our audience. At the same time, inflation should be very manageable and interest rates are low. So sounds like a Goldilocks kind of a year.
Which is what the RBI governor also called this situation here.
Thanks a lot, Neelkanth. And
thank you for
a very, very happy new year.
Likewise.
I hope you enjoyed this as much as we've enjoyed bringing it to you. Really look forward to your comments and feedback. Do like and subscribe to our channel to keep track of new episodes that are coming through. Thank you.